Welcome back everyone, and in this video, we are going over one of the top dividend growth companies on the market right now, and that is Home Depot. They just reported their fourth quarter results, and the company crushed analyst expectations. Sales grew 25% year over year, and they just announced a 10% increase in their annual dividend payment. And Home Depot is one of the few retailers that has actually benefited from the new stay-at-home economy. And in this video, we're going to discuss HD stock, go over the company's financials, and take a look at what Wall Street is predicting for the future growth of this company. But before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy in any major market news. So please hit that like button and subscribe for those daily videos. And we're going to start off by taking a look at the fourth quarter results from Home Depot, one of the largest retailers in the world. And if we take a closer look at the numbers, they generated revenue of $32.26 billion, beating the analyst expectation of $30.7. And their earnings per share numbers beat by 3 cents as well, coming in at $2.65. So this was a very strong quarter for the company, and they were able to grow net sales 25% year over year. And the growth in demand is really driven from DIY projects taking over consumers' lives. So now with our new stay-at-home economy, individuals are spending more time at home and are now taking the time and spending the money to improve their at-home living space. And we can see over this latest year, the average purchase at Home Depot grew 11% to now over $75. And the sales per square foot was up 24% year over year as well. And something that's very impressive from a traditional retailer, they saw 86% growth in their digital sales throughout 2020. And in the fourth quarter alone, online sales grew 83%. So we can see the company's doing a great job of prioritizing online growth. And they're also building up a digital audience, and their customers are more engaged online than ever before. And pre-pandemic, the company hosted around 5 in-person workshops every single month. And since they had to cancel those events, the company has now transitioned to hosting them online. And now each and every month, they are now producing more than 40 online live streams so they can reach a greater audience at greater scale and in a greater volume. So I think overall, Home Depot is one of the few traditional retailers that is doing a great job of adapting to the new digital landscape. And if we take a look, the company currently trades for $267 per share. And over the trailing 12 months, they have grown by just under 14%. Their current market cap is at $300 billion, and they're trading with a forward PE of around 23.5. And their current dividend yield is at 2.15%. And now if we take a closer look at the company's share price, they set their 52-week high back in August of 2020. And from that point, where they traded at $291 per share, the company now sits down 8.5% at the $267 level. And over these past 6 months, they have posted nothing but great financial results. Revenue and net income have gone up, but the company still continues to trade on a sideways chart. And if we take a closer look, for the full fiscal year of 2020, the company was able to generate $132 billion of total revenue, which was up 20% from the fiscal 2019 numbers. And their total net income came in at just below $13 billion, which was up from $11.2 billion back in 2019. So throughout 2020, the year of a global pandemic, when most companies saw a dramatic decline in their total revenue and income, Home Depot posted some very strong results. They were able to grow sales by close to $22 billion, and net income grew as well. And over this latest quarter, they also announced a 10% increase to their annual dividend payment, which is absolutely spectacular. And this is the 136th consecutive quarter that the company has returned investors with a cash payment. And if we take a look at their dividend summary, they have a current yield of 2.15% with a payout ratio just around 50% of their net income. And why they're one of the top dividend growth companies is because over the past 5 years, their average dividend growth rate is at 20.5%, which is absolutely incredible. So they grow their annual payment at a huge rate to investors. So your annual income, which may start out at a low yield around 2%, is compounding and growing at a tremendous rate year over year as you continue to hold the company. And the company also has a very high dividend safety score. It comes in at an 87, which is considered very safe. And it is extremely unlikely that we ever see a dividend cut from Home Depot over the next few years. And taking a look at the company's financials, 2020, like we saw, was a great year for their business. Total net sales grew close to 20% year over year, and net income was up 14% as well. And if we take a look, over the past decade, Home Depot has done a terrific job of increasing their operating and net margin. Back in 2010, they had an operating margin of 6.5%, and their net margin was only at 3.4%. But if we take a look, over the past decade, we can see continuous improvement, and right now, their net margins are coming in at around 10%, and their operating margin sits around 14% overall. So they've done a nice job of increasing profitability as time goes on. And now, if we move on to the balance sheet, we're going to take a look at Home Depot's current financial position. Over their latest report, we can see as of January 31st, 2021, they have total current assets of $28.4 billion. And if we compare that to their short-term debt of over 23, they have a current ratio nicely above 1. So over the short term, not really worried about any liquidity issues over the next 12 to 16 months. And overall, the company has $70.5 billion of total assets on the balance sheet. And if we compare that to their debt, that comes in at $67.2 billion, that is actually a very high number. Over the next few years, I'm not actually worried about their long-term debt. They will be able to handle the interest payments just fine, but over the longer term, I really want this company to reduce that debt level just to improve their overall financial health. And now that we've gone through the key statements, we can take a look at analyst predictions for the future of the company. And if we jump into the first report, they're predicting a 12-month price target of $307 per share, representing more than 11% upside from the current share price. And Home Depot is ranked as a buy. We have 8 strong buys, 17 buys, 9 holds, and only 1 single sell. And for the fiscal year of 2021, we're predicting total revenue growth of over 18%. And if we take a look at Yahoo Finance, over the next 5 years in the future, they're predicting close to 10% per year growth, and the company trading at $267 sits well below their analyst expectation of $307 as well. And this group of analysts gives the company a 2.1, which signals a buy rating. And Home Depot has also seen some great price target increases over the past few months as well. Morgan Stanley has raised their price target to $320 per share when it was already set at $300. So a very nice increase from one of the top investment companies on Wall Street. And we have also seen an upgrade from Zelman & Associates, and they have a price target on the company with a buy rating at $315 per share. And taking a look, CNN Business had a median price target of $312, representing more than 16% upside from the $260 price. And taking a look at the Wall Street Journal, they are also predicting a ton of upside to around $308 per share. So after taking a look at all these different analysts, we can get an overall consensus that they have a buy rating on Home Depot, and they're all expecting the share price to rise to around $310 or higher over the next 12 months. So right now, this is definitely an interesting time to buy in to one of the strongest retailers in the world. If the new DIY trend and the stay-home economy continues throughout 2021, we're actually predicting a lot of growth from Home Depot moving forward. And no matter what, I think this is going to be a brand where in-person retail remains very prominent. Home Depot sells products where you have to see what you're buying. It's very hard to shop online for a lot of the goods that they sell. So although traditional in-person retail is actually dying off in a lot of industries, I think Home Depot is a store that will see decline over time, but in no way is going extinct anytime soon. And even though we're transitioning to a more e-commerce based society, Home Depot is adopting to those transitions as well. They have done a terrific job of improving their online marketplace, and as a whole, the company has seen a terrific growth in e-commerce sales, which were up 86% in the 2020 fiscal year. And I think going forward, those e-commerce numbers are only going to continue to grow no matter what. So I think Home Depot's in a very interesting position. I think they're one of the few names where in-person retail is going to be a big player, and the e-commerce space is only going to be an added bonus to their already market leadership position. There's not going to be many competitors that come in and replace what Home Depot already has. They already have the loyal customers, they already have the brand, and they're already widely diversified all across North America. So definitely an interesting brand to take a look at. They're one of the strongest dividend growth companies on the market, averaging over 20% per year dividend growth. They're posting some strong financial results, and over the long term, the share price has performed extremely well, growing by massive results each and every year. So definitely take a look at Home Depot. Let me know down in the comments what you think about this company, and I want to thank you for watching to the end. I am the Gen Z Investor. Please hit that like button and subscribe, and I will see you in tomorrow's video.